Hello, my name is Troy Adkins, and I am the founder and owner of Adkins Capital Management. Adkins Capital Management is a housing advisory services company. I want to talk to you today about the key events that have transpired in the U.S. residential housing market during the third quarter of 2023. During the third quarter of this year, a review of the monetary policy actions of the Federal Reserve to help curtail the impact of inflation on the U.S. economy was the primary topic of conversation. This movie presentation also provides an overview of the home price level for a select group of cities that make up the Adkins 60 City Home Price Index, and it provides a wealth of information for prospective homebuyers to use in order to make a prudent home purchase decision. This presentation was written, narrated, edited, produced, and published by Troy Adkins. I am the founder and owner of Adkins Capital Management. Adkins Capital Management is a privately owned and independently operated company. Our exclusive focus is on residential real estate. ACM is not affiliated with any parties associated with the residential housing industry. Our mission is to bridge the gap in the residential housing market, where deficiencies in education, public policy, regulation, product structure, and personnel have created an environment where prospective homebuyers need objective information and useful analytical tools in order to help them make a prudent home purchase decision. As an investment professional, I have more than 15 years of real estate analysis experience, more than 10 years of institutional investment consulting experience, and more than 8 years of freelance financial writing experience. I am also the author of more than 25 published articles. For more information about my background, skills, and experience, please visit the Adkins Capital Management website. With this overview of Adkins Capital Management in mind, let me now turn your attention to our analysis of the Federal Reserve's monetary policy. The general theme of this section is that the Fed has set forth hawkish monetary policy via higher interest rates to curb inflation. The outstanding questions raised by Adkins Capital Management are: why did the Fed cut the reserve requirement to 0% in 2020, and when will it be raised? During the third quarter of this year, the Federal Reserve continued to convey that it is primarily concerned about reducing rampant inflation levels in the U.S. by implementing hawkish monetary policy. Accordingly, the Federal Reserve raised the target range for the federal funds rate from 5% and 5.25% in May to 5.25% and 5.5% in July, and then held that level for the remainder of the quarter. The Fed has raised rates 11 consecutive times since March of 2022. Moreover, it is easy to forget that the Federal Reserve was holding the federal funds rate at around zero as recently as the first quarter of 2022. To follow suit, the national average mortgage loan interest rate for a 30-year fully amortized fixed-rate loan began the quarter at 7.625% and ended the quarter at 7.81%. The national average mortgage loan interest rate for a 30-year fully amortized fixed-rate loan reached an all-time low of 2.67% on December 17th of 2020 and the all-time high of 18.63% in October of 1981. In light of the Fed's monetary policy position, it is perplexing to understand why a major monetary policy feature that is at the discretion of the Federal Reserve is not being utilized or even discussed in order to combat inflation in the U.S. For more than a decade, prior to March 26, 2020, the reserve requirement was fixed at 10%. At that level, the amount of money in circulation would have been curtailed to a level that would have helped mitigate inflation. Moreover, such policy strengthened the financial solvency of the U.S. banking system. However, on March 26, 2020, the Federal Reserve lowered the reserve requirement from 10% to 0% for all depository institutions. This policy provision dramatically raised the amount of money available to be in circulation, which in turn helped exacerbate inflation. With that in mind, it would be prudent monetary policy to raise the reserve requirement back to 10% to help curtail inflation, examine its impact on the inflation level, and if still necessary, continue raising the reserve requirement until inflation is brought down to an acceptable level. Such a position would also allow the Fed to implement a more dovish monetary policy in terms of interest rates, which in turn would help bolster the U.S. housing market, help the GSEs exit conservatorship, and strengthen the financial integrity of the banking system. Finally, it is important to note that it is prudent policy to have a reserve requirement of at least 10%, because it will mitigate the need for the Federal Reserve stress test, which is inadequate for measuring the stability of the U.S. banking system in an environment of rising inflation, rising interest rates, and recession. Simply explained, without a material reserve requirement level, the impact of a prolonged inverted yield curve could wreak havoc on the U.S. banking system, because the banking system's business model does not work in an environment where it has to borrow money on a short-term basis at high interest rates and lend money on a longer-term basis at lower interest rates. Now that I have provided an overview of the events and trends that have taken place in the residential housing environment for the quarter, let me turn your attention to the proprietary finance-based analytical methodology and cloud-based residential real estate analysis software application that you can use in order to provide an assessment of the price level of homes in your community, as well as for specific home purchase opportunities. The Adkins Residential Home Valuation Analyzer is an internet-based software application that analyzes the relationship between the median home price level for a city and the median household income level for the city. With this information, the software application takes into account the most recent month-ending national average mortgage loan interest rate for a 30-year fully amortized fixed-rate mortgage loan, and the assumption that no more than 28% of pre-tax household income should be spent by homeowners in order to repay the principal and interest costs for their mortgage loan. By utilizing this information, the Adkins Residential Home Valuation Analyzer can accurately assess the price level of homes in your city. From the first analytical perspective, the Adkins Residential Home Valuation Analyzer determines the level of underpricing or overpricing of homes in your city by calculating the mortgage loan interest rate that justifies the price level of homes in your city. With this information, the justified mortgage loan interest rate is compared against the national average mortgage loan interest rate in order to accurately quantify and assess the level of underpricing or overpricing of homes in your city. From the second analytical perspective, the Adkins Residential Home Valuation Analyzer calculates the percentage of household income that would have to be spent by the people that live in your city in order to justify the price level of homes in your city. With this information, the justified percentage of household income amount is compared against the traditionally accepted household income amount of 28% in order to accurately quantify and assess the level of underpricing or overpricing of homes in your city. By utilizing the Adkins Residential Home Valuation Analyzer, you can determine the level of underpricing or overpricing of homes in your community, as well as the magnitude of underpricing or overpricing of a specific home that you are considering to purchase. This, in turn, will help you make a prudent home purchase decision. For more information about our finance-based analytical methodology and the use of the Adkins Residential Home Valuation Analyzer, please review our finance-based analytical methodology report on the Adkins Capital Management website and watch the wealth of movie presentations that provide an overview of how the Adkins Residential Home Valuation Analyzer is utilized. Based on Adkins Capital Management's home price level analytical methodology, This section of our analysis pertains to ACM's housing analysis. The general theme of this section is that home price levels are overpriced in 55 cities among the Adkins 60 City Home Price Index. With this overview in mind, let us now focus on the assessment of the price level of homes across the country. Based upon the justified percentage of household income amount, 55 cities that make up the Adkins 60 City Home Price Index were classified as overpriced for the third quarter of 2023. San Francisco, Los Angeles, Newark, New York City, and Boston were identified as the 5 most overpriced cities in the index. In terms of a relative price level analysis, it is not possible to justify the home price level for the top 5 overpriced cities by reducing the 30-year fixed-rate mortgage loan interest rate from 7.81% to 0%. In addition, in terms of a relative price level analysis, it is not possible to justify the home price level for the top 5 overpriced cities as underpriced, because prospective homebuyers would have to spend more than the respective justified percentage of household income amounts, which falls within the unrealistic range of 89% to more than 100% of household income. In order to justify the median home price level for each city, the median required household income level would need to increase to a level within the respective range of $146,545 and $435,008. Based on the median household income level, the quarter-ending national average mortgage loan interest rate, and the assumption that no more than 28% of pre-tax household income should be spent in order to repay the principal and interest costs of a mortgage loan, the justified home price level for the top 5 overpriced cities fell within the respective range of $133,980 and $386,158. It is important to note that given the current interest rate environment, the justified home price level for the top 4 overpriced cities is lower than their required median household income level. Moreover, the lack of congruence between the median home price level and the justified home price level is particularly problematic for the housing industry in these cities. Prospective home buyers should use the Adkins Residential Home Valuation Analyzer in order to assess the level of overpricing of homes in their community. On the other side of the spectrum, based upon the justified percentage of household income amount, 5 cities that make up the Adkins 60 City Home Price Index were classified as underpriced for the third quarter of 2023. Detroit, Cleveland, Jackson, Des Moines, and Fargo were identified as the top 5 most underpriced cities in the index. In order to classify homes in the top 5 underpriced cities as overpriced, the national average mortgage loan interest rate would have to increase from 7.81% to more than the respective justified mortgage loan interest rate amount for each city, which fell within the range of 8.2% and 19.7%, or it would have to be deemed imprudent by prospective homebuyers to spend as much as the respective justified percentage of household income amount for each city in order to repay the costs of a mortgage loan. Given the recent events that have transpired in the residential housing market, and taking into account the fact that buying a home will likely be the largest single financial transaction that prospective homebuyers will ever make, and the bulk of their net worth will likely be tied up in their home, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to analyze residential real estate from 5 financial perspectives. First, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the level of underpricing or overpricing of homes in their community. Second, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the largest amount of money they should spend in order to purchase a home. Third, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the amount of money they would need to earn on an annual basis in order to be able to afford to purchase a specific home. Fourth, Prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess total home ownership costs expressed as a percentage of household income. And fifth, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess how much a home would need to appreciate in value each year in order to offset the costs associated with owning the home. By assessing residential real estate in this manner, prospective homebuyers will be able to make a prudent home purchase decision. For more information about the Adkins 60 City Home Price Index, to watch our catalog of residential housing movie presentations, or to subscribe to use the Adkins Residential Home Valuation Analyzer, please visit the Adkins Capital Management website at residentialrealestateanalysis.com. This is Troy Adkins, saying thank you for taking the time to listen to this presentation.